You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors. Hey, thanks for tuning into this week's episode of the Tax Smart REI podcast. Today, we're going to be going through how potential presidential tax changes may impact your real estate portfolio. We have a lot on what's been proposed by the current president, President Joe Biden, as well as VP Kamala Harris. We don't have that much to go on Donald Trump so far. However, in general, and you'll hear this as we go throughout the episode, it's very much expected that there will be an extension or perhaps even an expansion of some of the themes and favorable deductions that we've seen through the Tax Cuts and Jobs Act should Donald Trump become the next president of the United States. So we'll be diving into all of that in just 1 minute. Hey, are you an investor looking to slash your tax bill? Then get ready to discover everything you need to know about the short-term rental loophole to save up to 5 to 6 figures in taxes with our comprehensive STR task course. Valued at $247 is now just $1 for a limited time when you sign up for our Tax Smart Insiders community. Here's what you'll get when you sign up. Learn tested methods that have helped thousands of investors maximize their tax savings, get expert guidance and support from our team of real estate CPAs, and enjoy unlimited access to the course materials. Don't miss out on this incredible limited time offer. Visit www.taxsmartinvestors.com/free STR course to enroll today. Again, that's www.taxsmartinvestors.com/free STR course to enroll today. We'll see you there, but for now, we'll dive right into today's episode. All right, and we're back. So I think it probably makes sense to start going through a summary of each of Biden's and Kamala Harris's proposed tax plans and things that they proposed in the past to kind of see what the themes are. And then from there, we'll get into a little bit about what we do know about what Trump has said about potential things that he wants to implement and what we'd expect to see if Trump were to make it to the White House again. So, Brian, do you want to just kind of kick us off here?
Yeah, so we're going to start with a couple things from Biden's tax plan. So number one that we'll talk about is the corporate tax rate increase. Basically, he wants to raise the C corporation tax rate from 21%. That's what we currently have. And that became 21% with the Tax Cuts and Jobs Act back in 2017, 2018. But bring it up to 28%. And also increase the GILTI tax rate from 14% up to 21%. So a couple of things there. Big one being the corporate tax rate, the C corporation tax rate.
Yeah, absolutely. You know, I think as we go through this episode, I meant to mention this in the beginning. I think we're going to be focusing mostly on how this is going to impact the taxpayer more so than how this may impact the broader economy or broader fiscal and tax policy. If you do want to learn more about that, we do have a presidential tax tracker on the Real Estate CPA's website. So if you go to the realestatecpa.com, you can find the presidential tax tracker there. We'll go ahead and drop that into the show notes. If you do want to get a more detailed look on how this may impact the broader economy, I know Brandon and Nathan have done a bit of writing on that. But really today, I think we're just going to drill down in how that might impact taxpayers, because at the end of the day, it's probably why you're tuning into the show to see how that will impact you. So having said that, what I did want to mention, Ryan, is I think that regarding increasing corporate tax rates, this may drive owners of C corporations, whether it be large or small, out of the United States if it gets too, as we become less competitive from a tax perspective, right? That's because at the end of the day, the more money these corporations have to spend in taxes, the more money that they have to pay, the less favorable the U.S. becomes, and the more likely they are to move out of the United States, which could mean a few different things. For consumers, if you're going out there and buying things, they will most likely pass these additional taxes down to consumers via price increases. Some of them will absorb some of the costs, but I'd expect to see a raise in prices if this were to occur. So ignoring kind of the broader how that might impact U.S. tax revenues in general, increasing the corporate tax rate will make the U.S. a little less competitive than other locations. That's why, conversely, if you see Trump wants to actually decrease it from where it's at now down to 15%, make it even more competitive, bring even more corporations back to the U.S. So that's just interesting to see if you are owner of a C corporation. I know we don't have many who tune in. That's just something to keep in mind there. All right, next up, we have the excess business loss rules. So as a quick recap on what the excess business loss rules are, the excess business loss basically limits the amount of business losses that you can take against non-business income. And I think where this is most impactful for real estate investors comes to deducting your losses from your rental real estate against your W-2 income most specifically. And I believe the cap in for 2024 somewhere around $610,000 if you're married, about half that if you're single. Now, when bonus depreciation was at 100%, okay, this was particularly interesting for real estate investors because we had a number of investors maybe investing in multifamily or larger commercial projects that run these very large cost segregation studies. And perhaps if they or their spouse qualified as a real estate professional, they were able to use these losses to offset their W-2 or perhaps their spouse's W-2 income. And now, if this is going to be made permanent, those limits are going to be made permanent. They were set to expire around at the end of 2025, 2026, somewhere around there. But if these are made permanent, that could impact some high income earners, especially if 100% bonus depreciation is ever actually brought back.
Yeah, essentially the proposal here is that Biden would want to make excess business loss limitations permanent and basically just change the carry forward loss treatment on that. So that could have an impact, obviously, for those of you, depending on how they continue to change that for inflation moving forward too. Just again, limiting losses, and then potentially for real estate investors, like Tom mentioned, potentially increasing that amount of tax because we're taking less losses, so more tax to the taxpayer. Yep.
Yeah, absolutely.
The next one, essentially kind of a high earning employee deduction. So essentially applying a $1 million deduction limit to all C corporations and all employee compensation. Tom, do you actually want to speak a little bit more to that one and kind of that cap on the employees and the amount of deduction there for C Corps?
Yeah, so basically it's saying that C Corps, probably executives, vice presidents, people on the the upper rungs of a corporation, the maximum amount that the C corporations can be able to deduct is $1 million. So depending on what corporation is, that could be a substantial amount of money. Say the CEO is making $20 million, for example, in the case of like a Yahoo, right? That means that delta of that, say that 19 million, for example, will not be tax deductible. So that is further increases corporate tax rates if that were to come to fruition, right? And with that, again, my expectation would be if that were to happen, you're going to see an increase in prices, among other things. But as the consumer, as the taxpayer, like, you're putting yourself in your shoes, we're most likely going to see an increase in prices as a result of that, among other things. But that's kind of a bummer to see there.
Yeah, and do you know if that's $1 million for the whole corporation or is that $1 million per person? Do we know that?
Yeah, for certain top employees is what it indicates. So it
Oh,
seems like
that's pretty nuanced.
Yeah, so it seems like it's not going to be $1 million for all people. I think it's like if you're making over $1 million, that's just the max you could deduct per person. That's kind of what it seems like right here.
Got it. Okay. Next one is kind of a unique one. So it's a neighborhood homes credit. It would essentially introduce a tax credit to support affordable housing, kind of construction and rehab of these new homes, right? But the focus is affordable housing and basically a tax credit in order to, again, incentivize more of that affordable housing. So it makes sense. That's very common to other things, right? Kind of making homes more affordable, but incentivizing kind of the private sector to actually move forward and helping the government because they can't do all of this by themselves.
Yeah, absolutely. And there's some stipulations and some details that they've outlined for actually how that credit would work. But to your point, Ryan, at the end of the day, really what they're trying to support here and with the next one that we'll talk about is making housing more affordable, which is certainly commendable. And we do need to see that in the form of tax regulations, perhaps even regulatory cuts, probably at the state and local levels to facilitate and to foster new construction, because there's no doubt that we have affordability crisis, especially as Gen Z and the millennials continue to kind of move into those age brackets where they need housing. And it's not being built. And it's not exactly a secret. I'm sure we all know in the real estate industry what we're up against there. So that credit, I think, would certainly be a welcome addition for a lot of people. I think conversely, where Trump has his like kind of thing in that he's not mentioned much about his tax plan, but the Opportunity Zone program kind of in a roundabout way kind of aims to serve that same purpose by having these qualified opportunity zones that if you go and you invest, there's certain tax advantages to gentrifying these areas by renovating old buildings, putting up new construction, starting new businesses. So it's kind of like they're both aiming to kind of solve the same problem, just in different angles. And additionally, what Biden has proposed in the past or supported is expanding low income housing credit by increasing the allocation. So there's a limited amount of credits that could be given out in any given year, and the states kind of have to divvy it out. But it looks like they want to expand it and then reduce some of the requirements within that to make it easier for more people to get those low income housing tax credits, which would presumably spur additional development in that. And just as we're going through this here, you might be wondering yourself, well, why are we touching on Biden's proposals? Why not, VP Kamala? She's most likely going to be the Democratic nominee for president. And that's because, at least in my experience, what ends up happening or what I see is that, what they're putting forth kind of all would make it's kind of all under one umbrella. And what Biden proposes might end up making it into some way, shape, or form into future proposals by presumptive nominee Kamala Harris or whoever will ultimately be the nominee. There might be some crossover there. So that's kind of why we're going through Biden's, because it's kind of like a look through of what you might be able to expect. But both the neighborhood homes credit as well as the low income housing credit expansion, both of them aim to produce more affordable housing, which is much needed here in the United States. There's no doubt about that.
Yep.
Hey, are you tired of working with generalist CPAs that tell you can't use the real estate professional status, the short-term rental loophole, or cost segregation studies, or worse, have no idea what these things are? If so, it's time to elevate your game and work with a CPA firm that gets it. Here at Hall CPA, we worked with thousands of investors, helping them save millions of dollars in taxes through proactive tax strategy and planning, tax preparation, and outsourced accounting solutions. So if you're ready to elevate your game, make tax filing painless, and save thousands of dollars in taxes, what are you waiting for? Just head on over to www.therealestatecpa.com/podcast to request an initial consultation today. We are accepting clients for the 2023 and 2024 tax years, so if you're looking to make a change, you have nothing to lose. Again, you can request an initial consultation by visiting www.therealestatecpa.com/podcast. We look forward to hearing from you and learning more about your situation and how we can help. But for now, we'll dive right back into today's episode.
Another one, as we kind of move on to more taxes on high income earners. So number one would be like expanded net investment income tax. That's NIT. That's currently that 3.8% tax. Another one would be increasing the top marginal tax rate. Currently, we're sitting at 37%. They would want to move that, or Biden would want to move that back to 39.6. Again, that's part of his proposal. Also increasing the tax on high income capital gains and dividends, all at ordinary rates. So effectively would get rid of that whole kind of special treatment of long-term capital gains. And for dividends, it would be the kind of removing the beneficial treatment as well for the qualified dividends. Essentially, everything would be taxed at ordinary tax rates, so no difference there. And then on top of that, imposing a 25% wealth tax on anyone with net worth over $100 million. So quite a bit, obviously, trying to tax the top high income earners and just expanding kind of the rates, probably what's in there, getting rid of special treatment of various types of income that people are getting, like capital gains, dividends, and things like that, and just having it all kind of flat be treated as ordinary income tax.
Yes. So the net worth of over 100 million, interestingly on this, it'd be 25% of the sum of taxable income and unrealized gains. So minus any prepayments and regular tax. It's really interesting to see this if this were to ever come to fruition on unrealized gains. And to be clear, unrealized gains are like, okay, you have a stock, for example, and you bought it at $1. Let's just make it $1. And now it's went up to $200 a share, right? Even though you didn't sell it, you still have a gain, right? The gain's still there. You just didn't realize the gain. You realize the gain when you sell. So they maybe want to tax that. And that introduces all sorts of problems. Imagine this, right? And I didn't read anything about an exception to this, but imagine you own a business, right? You own the business, your business skyrockets in value, your net worth, right? And all of a sudden you have a tax on your business. Where are you going to get the money for that? What if you don't have the cash flow to pay for that tax and you have to sell off part of your business or leverage part of your business? I'm not saying this is exactly how it's going to end up working out, but I'm just saying that it's problematic to see that happen. And there's issues with that with estate tax, actually. There's a lot of issues that people face because sometimes you might have somebody with a business that is, highly appreciated throughout their lifetime. They go and pass that business on to their heirs, and the estate tax causes that to be partially taxed. And there's workarounds around that. But all I'm stating is that there could be problematic if that were to be introduced in the manner that it appears to be.
Yeah. And the other thing I was just going to mention too, I mentioned NIT, net investment income tax, being currently 3.8%. They would want to, or Biden has proposed, increasing that another 1.2%. So now that would be 5% instead of that 3.8%. So a little bit more there. And then as far as the 37% to 39.6, that would essentially be for taxable income over 450,000, or if you're single, 400,000. So depending on if you're a listener where your taxable income is, that would just be yet another 2.6% tax on anything above that taxable income for you.
Absolutely. So next they have individual tax credits that might be, they want to increase the child tax credit. So if you have children, that could be beneficial for you if you're able to qualify for those deductions. And then they also want to introduce a first-time home buyer tax credit. And again, this is the first-time home buyer tax credit appears to be driven to facilitate the acquisition of homes, right? Again, if you're a Gen Z or maybe you're a millennial, you're kind of in that range where you're buying your first home. The lack of construction, the lack of supply, pushing prices up. So they want to have the low-income housing tax credits, the neighborhood homes tax credit to help bring more supply into the market, presumably pushing down prices or at least stabilizing prices from continuing to skyrocket as we've seen over the last few years. And then with the first-time home buyer credit, that would presumably make it easier for people to acquire their first home.
Yep. I think I like that one personally. I've always thought something like that would be good, especially as we think about first-time home buyers, like you said, like probably not people who have a whole lot of money. Like I think of like people just graduating from college or just lower income who might not have that opportunity. And maybe they put a, hey, it's an income threshold. Like you can't get the credit if you make this much in income, sort of a thing. They do that with a lot of credits. They kind of phase it down. So we'll be curious to see if they propose something like that in the future. But I've always thought something like that, especially as someone who bought a home back in 2017, thought something like that certainly would have been valuable. Would I have made a different decision to purchase just because of that? No. But would it have helped? Absolutely. Yep.
Yeah, so they're looking at more specifically in that is a credit that would be equal to 10% with a maximum of $10,000 of the price of the home. And, interestingly, I don't know, how much that would actually help if I'm understanding this correctly, because say you're going to buy, I live here in New York. So say you buy a $500,000 house, it would actually be cheap for where I live in Long Island. But let's just say you did that, right? A $500,000 home and you get that maximum $10,000 credit. I mean, if you think about it, is that going to come from the down payment? Or, actually, because it's a tax credit to offset your taxes. Yeah, actually might make a little sense because you get $10,000 back, presuming you're paying over $10,000 in taxes. So yeah, I could see where that could be beneficial. That could help kind of ease the burden of getting to your first home. That could work.
Yep. The next one, and then we'll go to Kamala Harris's tax plans and her proposed, is essentially kind of closing some tax quote unquote loopholes. So one would be taxing the carried interest at ordinary rates instead of things like capital gains rates. Again, that comes back to something we talked about a few minutes ago. Capping a 1031 exchange, the amount of gains that you could defer. I think I remember back several months, maybe this a couple of years ago now, there was conversation around like 500,000 was the most that you could defer in gains. So that would be something that they would look to consider reducing, or maybe like $1 million if you're married. Another one would be taxing depreciation recapture, again, at ordinary rates instead of the special treatment of 25%, which we currently have. Yet another one would be adjusting plane depreciation, as in an airplane. Some unique things that come along with that. Maybe not a lot of our listeners have planes, but basically making that more not special treatment. Again, trying to remove some of those things in the tax world. And then increasing the jet fuel surtaxes. Again, a little bit of kind of a hit at people who can afford private jets would be my assumption. And trying to make sure that they've got no special treatment for tax perspective and they're paying their fair share. I'm sure is kind of what they're thinking around that.
Yeah, no, the jet stuff, I think may not impact a huge amount of our listener base. I know a few have some jets, maybe. But, the carried interest is interesting. So first of all, they're actually marketing these, quote unquote, as loopholes. But these actually aren't loopholes, okay? So the definition of a loophole is the ambiguity or inadequacy in such a system, such as law or security, which can be used to circumvent or otherwise avoid the purpose implied or explicitly stated of that system. Okay. And that's why the short-term rental loophole sometimes is considered a loophole, because even though it's in the tax code, sometimes, the purpose of the section 469, the past activity laws, the real estate professional status, was to prevent your typical taxpayer from being able to take losses from their rental real estate against their W-2 or active business income. And the short-term rental loophole kind of was meant for hotels and motels. And presumably, again, we've talked about this a lot. In the 80s and 90s, early 90s, your typical investor is not going to go buy a hotel or a motel. It's a business. It takes a lot more to run. But thanks to Airbnb, VRBO, made this a lot more accessible. So people kind of going around the past activity rules, using these rules which definitely certainly apply to short-term rentals, but were more meant for, I guess, more substantial businesses. They're going around it, right? So here, the carried interest, which certainly is going to impact real estate sponsors. So if you're a syndicator or fund, would certainly, basically right now, a portion of your gain, the compensation you get from being a syndicator or a sponsor, comes from the carried interest, which is, say, for example, the sponsors get 20% of the profits. Those are normally be taxed. The capital gains would be taxed at capital gains rates, not ordinary rates. And there's some controversy around that. The argument is that if a private equity fund manager or sponsor is getting this carried interest in exchange for services, right? Then they should be taxed at ordinary income rates, the same way that Ryan or I would be taxed ordinary income rates for exchanging money for services as a CPA or whatever other business that you're in. But it's not actually a loophole. This is like it's intentionally written to be used in that manner. So it's not a loophole. Also, the 1031 exchange is not a loophole. That's been around for a very long time. And the intention of the laws and regulations around that are very clear, to defer capital gains tax. I think the reason why they're calling these a loophole, and this is just my opinion, some speculation, is because think about your typical taxpayer, right? They have a W-2, they get some tax credits, they maybe get a refund at the end of the year. It's really easy to throw up, this is a loophole, some obscure loophole for people who are not in the real estate world. It's very easy to kind of say, look what they're doing. They're getting away with this. They're getting away with that, right? It's kind of what it seems like they're doing, okay? But the 1031 exchange and carried interest are certainly not loopholes, nor is taxing depreciation recapture, the portion from the actual building itself, at 25% a loophole. It's blatant that it's taxed at 25%. So I think this is a misnomer here, but that's kind of what they're going to market with. And obviously, I think this goes without saying, if you're a syndicator or fund manager, what the impact of having your carried interest be taxed at ordinary rates instead of capital gains rates, that's clearly disfavorable to syndicators and sponsors. And of course, capping the 1031 exchange at a maximum of $500,000 if you're single, or $1 million if you're married, certainly is not favorable. And then, of course, depreciation recapture. So I think that all goes without saying, but this is the impact that it might have if these laws come into fruition.
Yeah. And just to mention, like, these are obviously just coming from Biden. This is coming from the Green Book that was proposed earlier in 2024. So obviously he's dropped out of the presidential race and whatnot. But like Tom has said, this could be a part of the broader comments and kind of goals of the Democratic Party. So again, none of this is meant to be political. We're just kind of seeing these differences between the nominees and kind of putting them against what the differences are and how that might impact real estate investors. There's so much more that we have not touched. Tom and I are trying to split out, a 100-page document or whatever and just say, like, here's like a few things to comment on. There's so much more going on. But again, we're trying to boil it down and summarize it to you guys, the listeners, more real estate investors. So just want to comment on that before we move on.
Yeah, absolutely. This is supposed to be meant to, like, what could impact you and how it might impact you. And to Ryan's point, I don't think saying that, getting rid of the carried interest, the special tax rate that's taxed at, and capping 1031 exchanges is political at all. I think it's just looking at the policies and what is the impact of that policy going to be. And it's certainly not favorable to real estate investors. It's just not. So with that said, we'll leave the Biden tax plans behind. We'll move on to what Harris has, and what you're going to see. There's some common themes, right? There's some things that they're differing on, but there are some common themes. So I'll kick off the first one here: corporate tax rate increase. In the past, VP Harris has supported that corporate tax rate increase to 35% compared to Joe Biden's 28%. And I think we went through what the impact of that might be. Higher corporate tax rates at the end of the day drives more corporations out of the United States, most likely going to increase prices as corporations look to pass that along to consumers.
Yeah. And I think the interesting thing, I just want to, those of you who are smart are kind of, doing the math in your head. So Harris proposing a corporate tax rate, we're talking C Corps, right? 35% up here. Biden's was 28. We're currently at 21, and Trump is proposing a 15%. So thinking of kind of the Trump 15 to Kamala Harris's 35, over double, like 20% difference there in the profits from the C Corps. So pretty significant jump there. So a lot, like you mentioned, Tom, about people then considering, do we change from a C Corp to probably not an S Corp, right? These big corporations aren't going to all of a sudden become S Corps or anything silly like that.
Yeah, it's not going to happen.
But for new businesses, this might have an impact. Or like if you are an investor and you're like, hey, I'm going to establish this sort of extra business, you might make a difference there. If you're just getting started, or whatever your intentions are to, say, sell or exit a business, that may have an impact on you in the long term.
Absolutely.
Next one is kind of what she's calling the LIFT Act. So this would introduce a tax credit for families earning between 50 to 100,000, which would be essentially funded by repealing the Tax Cuts and Jobs Act. That one's interesting. I don't know, Tom. I mean, it's more of like kind of supporting families with another credit. We kind of talked about the child tax credit from Biden, but yeah, any comments you have from that?
Yeah, absolutely. I think it's just more going to support people in the lower tax brackets. $50 to $100,000, giving more credits, giving more relief, as they would say. That makes sense. I really don't have a particular stance on it outside of that. It just seems to be what they're looking at. What is interesting, though, this is interesting, the next one we have here, the premium tax for Medicare for all. And that is they want to implement she's supported, okay, implementing a 4% tax on incomes over $100,000. Now, I was speaking to somebody recently about this, and $100,000 is frankly a little low, especially if you look at what Biden's proposed in the past or what he stated. We're not going to increase taxes on people making less than 400,000. This obviously contradicts that, although that was something that Biden said, not necessarily Kamala Harris. But that's interesting. What do you think about that one?
It also seems low to me. 4% isn't like, oh my goodness, that's a lot. But, I could look at the tax tables really quick, but if you're, say, I don't know, what does that put you into? I guess it depends if you're married filing joint or if you're single and whatnot. But if you're paying at the, say, federal, 12% marginally, and now you're doing an additional 4%, so now you're at 16, that's a 33% increase in your tax. And I don't think we know exactly all of the okay, as soon as you hit 100,000, now anything above that is 4% and anything below is 100,000. Maybe that's exactly how that works. But point is, if you're in a low tax bracket and then all of a sudden you're kind of getting jumped up again, that's, I don't know, for someone only in 12 to now be at 16 pretty quickly. We have the jumps obviously from 12 to 22, but a little bit higher tax brackets. So just another tax on people who, yeah, it's fairly low overall for the income threshold, I would say, at $100,000. The next one, though, another kind of common theme here, right? High earning tax rates. So again, kind of applying the capital gains and dividends as ordinary income rates. So getting rid of that special treatment of either long-term capital gains being at a max of 20% or qualified dividends having that, again, special treatment there. Just everything would be ordinary income tax rates for high earners. And then essentially, again, kind of raising the top tax bracket from currently 37 now up to 39.6, specifically for the top 1%, which I kind of find interesting. I don't know how they're going to determine, is that an income threshold or whatever, but essentially just adding yet another increase in tax rate for those high income earners. And that's a very common theme from what we've seen so far.
Absolutely. And it's very much along the same lines as Biden. And again, this is not surprising. They're both from the same party. They were both part of the same administration. So it's not surprising to see some crossover. It's also not surprising to see some differences, but they all seem to be kind of along the same theme. The next one here, there's a transaction tax. VP Kamala Harris has supported in the past a tax on stock, bond, and derivative transactions. They're relatively minor, but when you add that all up, I'm sure it would be impactful for people who are involved in day trading and things like that. That could start to eat into your returns there if you're a successful day trader.
Yep. Another one, which is, again, yet another theme, not necessarily from Biden, but kind of rent control. So kind of the proposal would be supporting rent control and limiting rent increases to 5% for landlords with anyone over 50 units. I mean, that is, people have bigger portfolios. I know a lot of the US, as I think I remember a stat way back in the day, most landlords have no more than 10 properties or 2 or something. So that would really impact, they're kind of pinpointing, again, the higher income, higher wealth, but putting a flat, across the country, right? These are all federal. I know maybe we haven't said that explicitly, but these are at the federal level. So currently every state and county and cities are putting in their own rent controls. This would be federal wide, 5% rent control limits. So pretty substantial, what I would say. And just knowing a teeny bit of history on kind of rent controls and when they came out in the first place in the US, when they were mostly around kind of war times, to put that across the entire country when every single region is so different is really interesting. I've never seen any sort of proposal like this. But yeah, Tom, you have any comments on that?
I don't necessarily agree with this type of angle. I know a lot of investors don't. There could be issues with rent control. There's a lot of issues with rent control in cities like New York, where I'm kind of in that New York area, and it doesn't always work out the way it's intended. It kind of messes with the market dynamics. So while I do applaud other provisions proposed by Kamala or Biden, including, say, the neighborhoods homes credit or the low income housing credit expansion, those go to support housing and making housing more affordable. I'm not sure rent control makes sense, but this is what they're supported or supporting currently. So
Yeah, and the unique thing here, I'll just chime in and we can go to the next one, is that this isn't like a tax thing, right? It's more rent control where we're not saying like, hey, we're increasing tax on this or the rate or what's included, but we just wanted to mention it because it's unique. And it's obviously something that impacts real estate investors, which is our entire audience. So, not a tax thing, like explicitly, but definitely something that any real estate investor is going to want to know about.
yeah, for sure. And one more part in here is that I believe Biden supported something similar where if you did increase the rates more than 5%, you wouldn't be eligible for accelerated depreciation deductions. So that kind of is where it could kind of hit you as an investor as like a penalty. Like, okay, if you have rent increases above this, then above this threshold, then you're not going to be able to say use bonus depreciation if that remains intact, which could be an issue. And then the last one here on Kamala's plan, then we'll kind of tie out some common themes. Then we'll look at Trump's a little bit. Is she also supports very much the same proposals that Biden's put forth in the past about the 1031 exchange caps, closing the carried interest. And in general, it seems that both candidates in many ways support kind of the sunset or the expiration of many of the Tax Cuts and Jobs Act provisions, such as bonus depreciation. They want to let a lot of that expire, and that includes the QBI deduction. So if you have a small business and you're able to get the QBI deduction, or perhaps you have real estate that's eligible for the QBI deduction, that could also be a hit for people who are eligible for those. Now, interestingly, one thing I do want to mention here, we have not mentioned this on the show yet, is that we could finally put to rest, okay? Put to rest the 100% bonus depreciation coming back for 2023 or 2024 or retroactively, because the Senate just last week voted to shoot down the bill or block the bill that would support 100% bonus depreciation retroactively. And, who knows why that is and why that ultimately came about. But that means that for everybody listening, you don't have to wait to file your tax returns. Okay. Okay. And I know there's some syndicators out there that I was speaking to that are waiting to finalize the tax returns until after they got confirmation. So please go ahead and finalize those tax returns. Please send out the K1s to your investors. Do them all a favor. And so, yeah, I just wanted to mention that it does not look like 100% bonus depreciation will be coming back this year. The bill has officially been shot down. Who knows what will happen in 2025, depending on who gets in office. But for right now, I think it's safe to say that it's not happening. So,
yep. And just to comment too, you just mentioned like whoever comes into office, just even broader stroke here. Like we just mentioned, like this is Biden's, Harris's, and we'll get to Trump. Just a couple comments. We'll make this brief on Trump, but like it's only one portion of the bills that get passed. We got to go through the House, we got to go through the Senate. So it's all three parts of our government essentially working to pass bills. We're just kind of helping people understand from the presidential side kind of their tax proposals. So like you just said, like didn't go through the Senate. Okay, well, it never even got to the president, right? It never even got to Biden at this point. So point I'm just trying to make is like there's broader things going on than just, hey, this is what, the president says, this is what they want to do, therefore it happens. It's like, nope, we got like steps before that. But again, we're just trying to help people understand kind of the presidents and their proposals from recent past.
Yeah, absolutely. And just a brief history lesson here. I think we've seen this with the CARES Act. There were certain things that were going to make it into the CARES Act that didn't, such as I think they were trying to get rid of the 1031 exchange. And there's a bunch of clients who rushed to sell their properties because they were feared that the 1031 exchange would be eliminated. And that never actually made it into the bill itself. Also, the Build Back Better Act, all the talk about the Build Back Better Act, anybody who remembers that, the Biden's tax plan that he put forth, the proposal, that bill was dead. So that never even made it into water. So it made it into fruition. So I think something that we have to highlight here is just that what you hear people campaigning on or what they propose, at their campaign rallies or in writing or whatever, doesn't always necessarily translate, word for word or verbatim right into the tax law. There's compromises, there's things that get reconfigured, and then there's some things that flat out never make it. However, I think what is telling of this, where this is helpful, is you see the direction that they're thinking, the direction they want to go, and the themes that they present, right? So while not everything may make it into a bill that gets passed into law, you can see kind of where their head's at and what they would support, okay? So what we'll do here is we'll briefly recap some common themes between Biden and Kamala Harris's proposals and what they've supported in the past. And then we'll go into Trump, and then we'll wrap this up for today.
Awesome. Yeah. So just making this literally 30 seconds. One is increasing corporate tax rates So again, we're currently at 21. Biden had said 28. Kamala Harris had said 35%. So increasing the C corporation tax rates, higher taxes on wealthy individuals. A lot of like this, 1% here, or increasing NIT, or increasing the top tax bracket from 37 to 39.6, things like that. Closing tax loopholes. We talked about that. Carried interest, 1031 exchanges, supporting affordable housing. And then the last one would be continuation of certain Tax Cuts and Jobs Act expirations, just like letting them expire, which is the current plan. So those are like some common themes that we've seen. But yeah, Tom, do you want to start with some of Trump's proposals?
Yeah, absolutely. So Trump has been relatively quiet on the tax front. There are some things that he has said during his campaign, such as no taxes on tipped workers. And what's really interesting about that, I went and looked into that. It may not actually be that impactful because your average tip worker, I think what I was reading, makes less than $32,000 a year. So they're only paying like $1,900 in taxes, and reducing the taxes for them on that is actually not as impactful as you may think, but it's certainly something good to campaign on. I'll say that. But that's interesting. He also wants to eliminate taxes on Social Security for seniors. So giving seniors more income. And a lot of seniors, broadly speaking, tend to live on more fixed income, retirement accounts that might be fixed, or pensions, things like that. So that could help a lot of seniors. And again, we're not going to dig into how that might impact the broader economy, but that could be beneficial for seniors if that does come to fruition. He's also talked about reducing the federal corporate tax rate to 15%. So it's very starkly different. Whereas Biden and Kamala want to raise it to various degrees, he actually wants to reduce it down to 15%.
Yep. And then the last one be extending the Tax Cuts and Jobs Act tax laws. Again, currently they're on track to expire. Things like the qualified business income deduction and things like that. So he would just want to probably not only extend the expiration, but also maybe expand things that he's kind of mentioned in the past. So yeah, that's kind of the summary of his. We don't have, this whole detailed plan that we're going to go through, one for the sake of time, but also it sounds like he's been a little bit more quiet on that than kind of recent history as well.
Yeah. And the only thing I'll say on that is I think you could look at what Trump did with the Tax Cuts and Jobs Act, and you can kind of see what he supports. You can look at what's currently in place, bonus depreciation, the QBI deduction, condensed tax rates, things like that. Oh, you know what I think he wanted to make permanent? He wanted to make permanent the gift and estate tax exemption of I think it's currently somewhere between 12 or 13 million per individual. Double that if you're married. So the bottom line is here, I think you could see the themes of each kind of candidate or each party. And hopefully this is helpful in just kind of understanding what could come up the pipeline depending on who gets into office.
Yep. I don't think anyone is probably too surprised by what they're hearing from both sides. I feel like it generally follows kind of the things that they support as a party. So probably no huge surprises, but we just want to spend a little bit of time getting a bit more detailed into what could that look like and what has been proposed in the past. But we'll see. What actually comes through as bills is only going to happen until once it's actually signed into law. And that, as they come out, Tom and I will be spending time going through them. Things like the Tax Cuts and Jobs Act. I know you and Brandon did a little bit of talking about that on those episodes. So as those things come out, stay tuned to me and Tom talking about those things. It will be probably one of the first podcast episodes you listen to be discussing those things.
Yeah, absolutely. And if you do want a more thorough breakdown of these, more details on how this might actually impact the broader economy, not just, perhaps taxpayers specifically, we do have a presidential tax tracker on the realestatecpa.com. That'll be in the show notes. And as always, if you are looking for a new CPA, you can visit www.therealestatecpa.com/podcast. Fill out the brief form. We'd love to learn more about your situation, how we can help. But that's all for today. We'll catch you on next week's episode of the Tax Smart REI podcast.